Hey everyone, Dan here. We are after market close on Wednesday, June 30th. We're going to do our daily look at SoFi. Before we get into it, if you enjoy these videos, please hit the like and subscribe button. It helps a lot. And also, I have a free newsletter that I'm going to be sending out once or twice a week at the most, sometime down the line in a month or two. And I have a link in the description below for you to throw your email into a Google form if you'd like to be on that list for the newsletter. I'll send an update when it's ready to come out and say, hey, here's what it's going to be. Here's the formats and here's the frequency. If you want to opt out, feel free to opt out now. But do that just if you want another touch points, ways that we can sort of not be like solely reliant on YouTube, but have another place to exchange info. And I can send additional trade ideas and things to look out for there that I just don't have time to make videos for during the week. So that's the idea. All right. SoFi had a good day today. I mean, this is the guy who said yesterday was a good day. But I think that was true. But today we had a green day at least, and we see here volume starting to normalize a bit. 27 million in volume today, still dragging that 3-month average up, of course. So probably getting ourselves into double digits here very soon, and then sort of trying to find a sort of like a place where SoFi's volume will stabilize and kind of have a true average. So there's a bunch of data to go over today. You probably know that we got some new data released. So basically the structure of the video, we'll do a quick update on the chart since it was mostly a sideways day. I think that that'll be pretty easy to get through. Then we'll do a quick look on the daily short interest, and then we'll dive in deep to the fails to deliver and some potential catalyst dates that I see coming up based on the fails to deliver data. All right, so the charting aspect of things, let's zoom in a bit here. So on our 5-day, 5-minute chart, you had a nice run up here this morning and then some topping outs. You basically triple topped out here or so, and then the selling pressure just kind of gave in since it wasn't able to breach that $20 mark and get support there. Came down to this 1925, which we had charted for a long time now, and has found itself support there. Now it has slipped under there a bit in the after hours, and actually at market close it did, but to me this is still within the range. Right now it's sitting 12 cents below, and our current ATR is 8 cents. So it's still right there knocking on the door just underneath the resistance zone. So if can get that turn to support, that'll be a good jumping off point. It does seem to have this collection zone. This white box is just sort of like collects price activity. So if it does come down, I would expect it to bounce off of that 1872 area. But if it did, to me, it would be coming down to just consume more of that like buying selling pressure that exists for whatever reason in that zone. Let's see if we zoom out a bit if we see anything interesting in that area. My computer seems to be running a little slow for some reason. This isn't Weeble's fault. I have a link in the description below for Weeble as well if you'd like to try out this charting software. They're also a free broker, but they have really good tools, and I would recommend them highly. Well, you do see this white boxy area. It's this white box. I was like, holy moly. So it's right in that 1872 zone. Just trying to trace back. I mean, there was a bunch of price activity. That's sort of where it consolidated here as well previously. And then when it had its first run up, oh, that's interesting. When it had its first big run up, it consolidated along that 1872 line. So that was back in January. So it could be just a ton. I mean, that's always been in play. It's in play here and it's in play here. So it's just always been a really important zone for IPOE and then SoFi. So for whatever reason, I wouldn't be scared of that zone. I think that it's just one of those things, and once it sort of gets enough separation from it, it will never return. And it'll develop the equivalent of that at a much higher price, essentially. But it seems to be just sort of where it tends to want to consolidate. into. So that's what I see there. On the indicators side of things, got the RSI sitting pretty low actually since that dip at the end of the day there. So plenty of opportunity for buying pressure to be coming in. And then on the MACD, we're sitting below the baseline. Very nice positioning. If we want to get a bullish crossover going here and a nice push up, there's plenty of room. Bullish pressure is still coming in quite nicely. So it came in quite strong here and then, had a little bit of a downturn, but then came in so strong that it actually bumped up a little bit over this previous area here. Now, nothing is contended yet with this area where we saw this big run up the other day. And certainly this area here, which even dwarfs that one, that got us, that bull run at the end of the day on the 28th. But MACD holding up pretty strong. Nice to see that it's under the baseline and sort of like providing opportunity to have a nice big swing upward. All right, let's flip over to the data. Before we get too deep into the data, there's another broker I have linked in the description below, Gatsby. They're a really quick, easy, modern UI, UX. You can go in and just execute trades really quick, really simple. I really like that app. I think that they're only on mobile, iOS and Android. So I don't do the charting there, but I go in and I know what I want to buy or sell, and I go in and do it, and it's a really nice experience. They're also free, so check them out at the description below if you'd like. SoFi short volume ratio from yesterday. So my take on this was basically there was this like enormous day, right? This big spike here that you see, and then pulled back into for SoFi normalish territory of being daily short volume ratio in the 20s. But then they started to really retreat, and this is when I was saying, shorts seem to be staying away right now, so it would be a really good time for SoFi to try to make a push and a recovery and get some stabilization going because the shorts are staying away at the moment. So that seems to potentially still kind of be the case, and I'll point out more info on that soon, but I do think later in the day today some shorts started to come in, and I'll show you that in a second. We'll flip over here to eyebrow disc, which thankfully is still staying relatively up to date. I mean, 315, or is that? Oh no, it's 415, so we're good. Yeah, so this is still updating. I did send out a tweet earlier today. I basically screenshotted this area and showed this rundown from 3.8 million to 3.5 million to 2.6 million and said, okay, just be aware that while SoFi is having a nice day today, there are a bunch of shorts that are choosing to come in at this time. There's millions of shorts surely coming in because, again, this feed is just from Interactive Brokers. This is one broker-dealer and the supply that they have going out to short sellers. So multiply that out by all the other broker-dealers, assuming that it's pretty similar across the board, and that's what you would have. But all told, nice green day today because a lot of shorts closed out overnight. So nearly 2 million shares coming back into the supply on Interactive Brokers at least, and then reaching all the way up to 4 million at one point today. So, and then you see them start to decide to come back in basically after like 1 o'clock today. So if we look at, how that played out on the chart, after 1 o'clock today, they started to come in. So that's right about here. They started to come in. So you see a bit of a run up, and then that's when we had that, constant push down right at about 1:15 or so that started to take off. So interesting timing there, but sort of like aligns with, okay, this is probably reflective of what's going on in other broker dealers and the amounts that are being pulled out of each of them in order to short sell into SoFi. Okay, so now we're going to get into a couple of things. One, I want to do a really quick recap on what failings to deliver are and sort of like what the expectations are, what the regulations are, and then we're going to talk about some of the historical data when it was IPOE, and then we'll get into the SoFi side of things, and I'm going to call out a few dates that I think we're really, really going to want to keep an eye on because there might be potential failings to deliver catalyst fueling some solid gains on those days. So this is a rule from the show rule. Commission also adopted these rules, blah, 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 requiring that short sellers and their broker-dealers deliver securities by the close of business on the settlement date. 3 days, so T+3. and imposing penalties for failure to do so, as noted above. Yada, yada, yada. Rule 204. Okay, so market makers have extra time, yada, yada. One major distinction, failed to deliver positions related to sales pursuant to Rule 144 have 36 settlement days to close out, usually T plus 39. So the day of the trade, that's T, plus 39 days after that. So there's that piece of information. And then there's also this from Investopedia. What is an age fail? An age fail is a transaction between a buyer and a seller, basically, that has not been settled within 30 days of the trade. So usually this looks like somebody has sent the money. So you bought a share of SoFi, and essentially the person who you bought it from wasn't actually able to locate and deliver to you the share that you bought. So they essentially mark your share, even though it acts as a share and you don't know any different as you're holding it. It's essentially an IOU. You paid for this, you're owed it, but we can't locate the exact thing yet. So just imagine that if you sell it after 10 days and it still hasn't been delivered, then that IOU just is floating around in the pool of shares. And for the time period in which a bunch of IOUs are floating around, think of the distortion that then occurs in the market. So there's a real share sitting out there, and then there's an IOU. So there's essentially a 2-to-1 situation going on for those shares. And think of the distortion that then sort of infuses into the market, where it looks like there's way, way, way more supply than demand. Looks like there's way, way, way more shares available, or shares out there, or shares being traded than actually exist. So that sort of lopsided equation of, hey, there's a ton of supply and not as much demand, that's when selling happens, right? That's when something is seen to be not as valuable. So that's part of the distortion that happens here. Now Investopedia says aged fail is something that's not been settled 30 days after the trade date, so T plus 30, and they're essentially saying that if the seller, parties failing to deliver cash or securities to settle a transaction in a timely fashion are subject to specific charges by the SEC to cover counterparty risk. Dealers have to maintain additional capital for fails to deliver 5 or more business days. So there are some, things in place trying to obviously disincentivize broker-dealers from failing to deliver and from dragging it on and for letting them age. But obviously, there's been a lot of questions about how big the teeth are that these regulations have. Are they really taken seriously? Probably not by a lot, but let me get a sip of water here. I might have to do some water breaks for the time being, since it is incredibly hot, as I'm sure you know. So let's keep these things in mind. Let's keep in mind T plus 39 that comes from the SEC files here, and let's keep in mind this 30 days after the trade time frame here. Okay, so let's now look at what happened when IPOE had all of these fails to deliver. There were considerable quantities. So I'm typically looking at the ones that are over 1 million on any given day. And so we see here from May 10th to May 20th, there were 5 peaks, 5 days over 1 million there. And basically that's 30 days after that. I had made a note up here, is June 9th through 18th. So June 9th through 18th, those were going to be coming due, essentially. And let's take a look at what happened. Now, I think one of the misconceptions, or sort of like a misguided approach here, is to think that if 30 days, to set this aside, and let me just say this for a minute. There's a lot of info floating out there about T plus 21. If somebody has links on T plus 21, which are like official-ish links, like I just showed the SEC websites for the T plus 39. There's a lot of talk about T plus 21. I can't find anything on it except for folks just posting that it's a thing. But what I want to see is the source documentation of why do folks think that that's a thing. If somebody has that link and can drop it in the comments below, I would really, really appreciate it. But what I'm saying is, let's look at the 30 days after, May 10th through May 20th. And I think folks tend to think that, oh, okay, so if 30 days after May 10th is June 9th, things are going to run up hardcore. But I don't think that that's actually what happens. I think what happens is instead of them waiting to the very last day to effectuate the closing of these fails to deliver, or the delivering of these fails to deliver so that they don't go into aged status, I think they close out positions close to that date, but I think that there's sort of like a rolling run up to that date. So there's contribution to green days in advance of that date that might even end a couple of days before the actual 30th day after the fails to deliver spiked. So let's look at that in this instance, June 9th through 18th. So let me zoom in on those days. We have June 9th here, and we have June 18th here. Okay, so we're looking from here to here. And obviously we see big dipping, right? As though there wasn't a lot of buying. But let's break it down a little bit more concisely. So we have here the 9th, when a bunch of them were going to start to come due. And we know that we then had 4 additional days between here and here where many more fails to deliver were coming due, lest they go into, aged status. So I think a big part of this run up here, which everyone was scratching their head going, what? And I know there was speculation of SoftBank, but that seemed to have been old news and stuff like that. We were talking about shorts had taken out a bunch of positions toward the peak here. But I think a bunch of this run up was probably grabbing up shares at a very low price, right? There had just been this like big manipulation the day before, and the price was sitting really low. Maybe some were even buying up here in order to collect shares that they could then deliver that they owed on. That is, if they couldn't locate them for some other reason, then they had to just go buy some. And so they could have started this process like down here under $20, driven it down under $20 and start to get cheaper prices, buy them up so that you can deliver what you're supposed to be delivering in this time frame. Okay, but you start to pick dates leading up to that when, I'll say this now. So here's what I think is happening a lot of times. We'll show more evidence of this later. I think a lot of times what's happening is shorts are coming in heavy volume, like we see the other day here. Why? Why come in that heavy on that day? Well, there's a good opportunity for funds to drive the price down as much as they can in advance of these days that they're needing to deliver shares. So if they're needing to deliver shares in this window, why not spend the week or week and a half before driving the price down and then start buying it up at cheap areas and collect all of the stocks that you needed to collect in order to deliver, stocks that you probably sold at a much higher price, and then you're buying them at this price and then selling or delivering them to the person who bought them in the first place, about 30 days too late. If we look at the price that we had here, it was in the 16. So I guess in this instance, they would be mostly or probably all buying back more expensive shares, but there was a heck of an effort to drive that down into an area where I'm sure it would have saved millions or billions of dollars to close out those positions, that way. So that's what I think is happening, leading up to windows of dates that are impactful, over 1 million showing up. So now let's move on to today. So wanted to thank Jay here on Twitter. He sent me this. He had put this spreadsheet together, basically summing up what was in the report for the fails to deliver. So he has about 6.3 million by his calculation just in the first half of the month. Okay, and we go here and we take a look at the data for ourselves. Here's the price and here's the fails to deliver. Now, interestingly enough, you see the price starts to creep up and the failures to deliver start generally coming along with it. So for whatever reason, as the price started to come up, there were more and more broker-dealers as time went on who just couldn't seem to locate the shares that they had sold at higher prices. So what could be an advantageous thing to do? Well, don't deliver them yet. Drive that price down. Like, we don't want to be buying them here at 23. We want to be buying them here at almost 24. Drive that price down. Get it well under 20. And then let's buy them up. And that way we will have short sold those to begin with, failed to deliver on them, and then make an additional bump by buying the stock back, when it's $4, $3, $4, $5 a share cheaper, and delivering them that one that's cheaper. I'll give them that one. Until then, they just have the IOU. So think of how that can sort of play out in real life. Starting to fail to deliver in high quantities as the price rises, driving the stock price down through short tactics, and then buying up a bunch of cheaper shares within a time frame that you're able to deliver the shares that you sold already at a much higher price, and then kind of like move on, without having the aged issues and fines and fees coming in. So if we look at these dates, these 30 days from these dates are July 1st and these are just 2 dates, because the only two that stretch over 1 million are May 31st and June 13th. So 30 days, or the first trading day with, after 30 calendar days, with those days is July 1st and July 13th. So July 1st has obviously already happened. So what did we see on the lead up to July 1st? We saw this massive run. Okay, so think if that was partially fueled by buying millions of shares to then deliver on, because you have by Jay's calculation, over the course of the next 2 weeks, you have to deliver 6 million shares. Okay, so if you're buying them up super cheap down here, under 18 and well under 20, even if you bought late, and then you assist driving the stock up. I'm not saying that this is the sole driver of the stock movement, but I'm saying these things, it's not typically like one thing is driving a stock. Sometimes that happens, but more often than not, you're taking into account the fails to deliver, the short interest on the free float, the buying pressure, the organic selling pressure, the retail interest, news catalysts, analysts coming out with ratings, all these sorts of things all are a factor in the price movement in any given day, but they come together as sort of like an equation, adding to each other to account for the overall structure of the day. So imagine if that was a bunch of buying up in order to be able to lay out some of those 6 million that are going to get aged, or going to be considered aged, between July 1st and July 13th. Well, that leaves us still a big window here. We're just about to get into that time frame. And so will we see additional buying pressure coming up? Will we see them coming in and trying to push the price down again to the 17-18 zone in order to buy up a bunch of shares? Or will they be happy getting them at this price right now, knowing that when they sold them in the first place, they were selling them for well above 20, 22, 23 bucks. And they're happy to buy in under 20, and so we'll see in the next coming days more buying pressure coming in to fill that 6 million that needs to be covered. And just know that like some of those 6 million are going to be for legitimate reasons. So it's not actually like 6 million, but for whatever reason, anything that's still outstanding that can't be delivered on, can't be located because maybe there's nothing to locate, those may have to be bought in the open markets in order to be delivered and then not aged. Okay, so there's that. Now if we take a look here at Vortex, which I almost just called SoFi, we can see it here in a slightly different way. So we see this blue line here that's cutting through. This is the exchange reported short interest in SoFi. Okay, so we see the short interest coming up quite significantly, while these yellow bars down here are the fails to deliver. Okay, so I'm going to stop scrolling so that it's not nauseating. But you see this blue bar going up, so short interest is increasing while they're failing to deliver, and the price is moving up. The red and the green on the chart here, these are the price points, ranges for the days. And so you see short interest going up as fails to deliver go up. It sort of hits a nexus point, and then the price starts to drop a bit, tries to recover, and then drops significantly more. So fails to deliver peaking out over here when the price is up in this range, and then dropping it down into this range down here, well below 20, and volume picking up significantly. So this to me is just another representation of the thing that I just explained, where I think that there's strong likelihood for the situation of short interest coming up while they're failing to deliver because the price is going up. Short interest reaches a peak, starts to drive the price down, and then a bunch of those fails to deliver can be bought and delivered at a much cheaper price. All right, thank you, Vortex, for the cool chart. So that's what I would say about the fails to deliver at this point. That's what I'm looking at. So hopefully that makes sense. A quick, update from last night. Basically last night in the video we said max pain for this week, and again I can get into this more, but basically if market makers can pin SoFi's price to as close to $20 as possible on Friday, that'll mean that the most options expire worthless, therefore not having to exchange any hands, not getting exercised. And funnily enough, we see here at 20, the open interest is, I think we can get a refresh on this actually. Okay, is growing. You saw it was 10,000 yesterday, now it's over 15,000. So multiply that by 100, and you would have that many shares that would be changing hands if those calls at $20 on Friday all expired in the money. I think that that could kick off a gamma squeeze, because there's also not only this 15,513 contracts, but there's all these contracts above it. Multiply all of them by 100 shares per contract, and that's the number of shares that would have to be delivered as those options contracts are exercised. Now, to the extent that any of these were nakedly underwritten, like selling calls that aren't covered, then theoretically whoever sold that would have to go buy them and deliver them that way. And so that's a lot of potential buying pressure after close on Friday. So that's what I'm looking at in the coming days. I think that's it. A lot to get through today. I don't think we've ever approached half an hour on a video before, but the new data only comes out every so often, so it's kind of a special day when it does. But if you made it this far, I really appreciate it. Feel free to share this video if you found it so interesting that you lasted almost 30 minutes. Reddit, Twitter, Facebook, any of these things are super, super helpful, and I appreciate it. And yeah, thanks a bunch for watching. I will see you in the next video.